ChatGPT is amazing for all sorts of stuff. Don't use it for tax research. It will give you things that sound very legit with court cases that it references, but they are fake court cases.
Oh my. Hold on, I need to make a call. I'm just kidding. Hey everybody, welcome to an episode of Landlord Lens. We are joined today by two tax professionals who are really well known in the industry, Amanda and Matt from Keystone CPA. Welcome to the show, guys.
Thanks, John. Thanks for having us. Appreciate it.
Yeah, excited to be here.
Very excited to have you guys. Where I'd love to start is to get to know you guys a little bit better, is how you guys ended up at Keystone CPA and how you've built that business. So would love to hear the origin story.
Yes. Well, our firm specializes in working with real estate investors sort of nationwide. And the reason we started Keystone CPA was because we actually decided to invest in real estate ourselves. So we started our career in one of the big four public accounting firms where we happened to be in the real estate specialty group. But it wasn't until we started investing in real estate personally that we realized, everyday investors don't get access to some of the same strategies that a lot of our clients at the big firms were utilizing. So kind of sparked our passion down this path of not simply being a CPA or simply being an investor, but being a real estate CPA.
Yeah, and for full disclosure, for anyone who doesn't know, we are married to each other. So before this kind of gets weird in the conversation, but no, we met working at a big four firm, and I worked in the kind of high net worth individual group, and I remember working on an individual's tax return, and he was probably in his 60s at that point in time. I was probably in my early 20s, and this guy was retired, but it was clear from looking at his tax return that he was, when you account for the depreciation, he was making over six figures in cash flow and not paying any taxes. And I was like, that's kind of when the light bulb went off, like, hey, there's something here, and so I kind of just started working more and more with real estate investors. Kind of that's what I like doing. And then when we decided to start our own firm, it was a natural transition to kind of focusing on that area for those individuals.
That makes a lot of sense. One question that immediately jumps to mind for me is, when you guys started doing your own accounting for your real estate investments and you thought of all of the mechanisms and devices you were using for the clients, where is the overlap 100%? Like, how many immediately, we should obviously do this because we did this over here, was there? Are there some examples of that?
It's interesting. I think that a lot of people overpay in taxes because we feel like, there's not much I can do to save on tax. I think most Americans in the media talk about how, tax breaks are for the wealthy, the super wealthy and the big corporations. And I think sometimes it's shocking when we share the stories that Matt and I, when we were just, working full time, no investments, nothing at all, we had the same mindset. We're like, wow, this client made a lot of money, paid no taxes, but it was sort of like, well, that was for him, right? Because that's not for us. Like, how could we own real estate? We're not super wealthy. And so it actually took us a couple years before we said, well, let's try it out ourselves too. Let's try to get into properties ourselves and actually implement it. So I do understand the mind frame of a lot of our new clients who are like, I don't know, am I at that level where I can actually do anything? But I think that's the best part about taxes is we all play by the same rules. So it's not just for the super wealthy, but tax benefit is for the people who are informed, right? So by listening to this podcast, by taking time to understand it, the same strategies we use for ourselves are the ones that our clients use. We teach them to do the same things.
And I think some of the overlap too is that when you see as CPAs, right, you see how important good financial records are, especially for your rental properties, especially for your businesses. And then you can kind of translate that to clients, like talking about all the pros and cons and all that kind of, because, things will come across our desk like, yeah, that's not helping you. That financial statement's not helping you make decisions. That's hurting you because you're not looking at it for 6 months, or you're trying to get investors and you're giving them an Excel sheet instead of financial statements. That's not going to work for, the higher end syndicated deals,
Super interesting. So one of the clear overlaps is, and what you were able to do for your clients is that clarity of the information, right? The actual reporting, the clear financial records that are feeding into meaningful reports. Would you say that's the most common tax mistake landlords make, or the most common category maybe of mistakes, or is there something different?
I mean, there's so many. I think the one mistake was, I was saying is not understanding that you can actually control, right, to a certain extent how much taxes you pay. But along the lines of, good financial records, yes, that is a common mistake. People think, well, I'm just a small landlord. I maybe have 1 to 3 rental properties, and so I'm just going to sort of maybe track it haphazardly. And so I think having a system in place, right, like through TurboTenant or having software where it's systematized and streamlined and automated so you don't have to rely on, oh, did I record this? Did I record that? So people love to talk about tax planning. But tax planning, the foundation of tax planning is having good numbers. And so we can't tax plan if we don't know what numbers we're working with, right?
Yeah, because I think in our experience, most real estate investors are pretty good at capturing those deductions that are tied to the properties, mortgage interest, property taxes, insurance. But it's all that other stuff of kind of, we call it like overhead costs of being a investor, being a business owner. So you've got your meals, you've got your travel costs, you've got business development, you've got subscriptions, dues, whatever. That's the stuff that I think people often overlook, either because they got bad records, they don't know what they can deduct. That's the kind of stuff we see.
I see. And I can see how that's especially challenging too, because some of those things you might be putting on a different credit card than the one you did for the Home Depot on the flip.
Right,
Yeah.
right.
Yeah, exactly. So I think a best practice for landlords is if you have an LLC that holds title to your rental properties, then generally you want to have a bank account, right, and a credit card in the name of the entity so that it's easier. Business expenses coming out of there, income goes into there. But even for landlords who don't have legal entities, it still could make sense to just have a separate bank account and credit card account dedicated to your investment activities. And so that way it's easy, right? We know like, hey, everything that came from this card is related to my rental business.
Gotcha. Okay. So linking your accounts to the rental business, maybe even at the property level, depending on how you got your entity set up, is a huge unlock in terms of automation availability and clarity of the finances.
Yeah, it just saves a lot of time and headache from, when it's time to do books, right? Because if you just pay everything with your personal account, you have to sift through hundreds and hundreds of transactions just to say, is this business? I don't remember what I ate for breakfast a couple days ago, so I certainly don't remember, what this Costco receipt was for, right?
Yeah, 100%. And that makes a lot of sense. It would lead me in some cases to not even go through it, right? And just say,
Yeah.
take what I got. I'm not going to go through this.
God forbid people hate tax time, right?
Yeah, exactly. Oh, that means less work for me? Great. So really setting up systems so that you're not stressed about needing to find the information that your accountant needs to file it well.
Yeah, for sure. I think that takes a lot of headache and stress off the table. And as Amanda mentioned, kind of sets you up for that good foundation of kind of taking that next level to doing proactive tax planning so that you can figure out what are the strategies I should put into place for my situation based on what I've got going on, what I want to do, what my goals are, that kind of thing.
That makes a lot of sense. I have questions here that are a little more tactical, but before I jump into those, I'd love to get from you guys as CPAs for some pretty high profile folks that have a lot of money, right, wrapped up in real estate. And you guys have been doing this since your 20s, right, helping these folks. What are some advice you'd give to landlords about interfacing with their accountant? What should that relationship look like? What should they be bringing to those conversations with you?
Yeah, I think it's a common misconception that people feel like it's scary or unpleasant to meet with their CPA. And I think the reason people feel that way is because they probably only meet with them during tax time. And sometimes it's not the greatest of conversations, which is like, hey, this is how much taxes you owe, or you're getting a less refund because of XYZ. But a good relationship with your tax advisor is really one that comes from proactive planning. And proactive planning is not a big complicated thing where you have to become a CPA yourself and learn all the different ways to take depreciation. Proactive planning is actually just a simple conversation that you have with your CPA throughout the year, before you buy a rental, before you sell a property, before you refinance, before you partner with others, before you hire a property manager or fire your property manager. And it's really just in those kind of update conversations that your CPA, your tax advisor, can ask really great questions, which will lead to strategies, right?
Yeah.
Like, oh, I'm thinking of selling a property. Well, here are the 3 things we want to consider, right? Which one makes the most sense for you? So I think the one tip is keep that line of communication open, and understand your accountant should be your ally. They don't work for the IRS. So share with them what you have going on so that they can help you.
Yeah, and that can be as simple as an email too, right? Like it's just like, hey, I'm thinking about doing this, and then if it's something that needs to lead to a conversation, so be it, right? But it doesn't have to be doesn't have to be a 5 hour long drawn out conversation. Sometimes it's as simple as just, hey, that email sparked something from your accountant or CPA to think about doing it a slightly different way, and that could help you, right?
Absolutely. That makes sense. How many, if you would just ballpark it for me, what percent of real estate investors do you think actually reach out to their CPA during the transition events that you guys listed off?
Oh, very few. I can't give you a percentage, but very few.
Okay.
And even for some of our clients, we're probably one of the more or most proactive firms. But yeah, sometimes, client will call us after they hear us on a podcast and say, oh, you reminded me to call you, right? And
Yeah.
so it's just setting up a system or reminding yourself, right? Like learn that in the back of your mind, like, oh, okay, before I do something, is this a good time for me to just notify my CPA? And I think sometimes a lot of CPAs charge by the hour, by the phone call, or by the email. If I spend time with you, I'm going to charge you. And that's what deters people from contacting their CPA, and they start chat GPTing, if that's a word down, chat GPT the questions. And for everyone listening, guys, chat GPT is amazing for all sorts of stuff. Don't use it for tax research because it will hallucinate. It will give you things that sound very legit with court cases that it references, but they are fake court cases oftentimes.
Oh my. Hold on, I need to make a call. I'm just kidding.
No, I think ChatGPT 5.0, 5.0, whatever it's called, just came out recently, and I was just reading an article about it. It was like, I don't know if it was hallucinating, but it was, somebody was testing it, right? And was like, hey, give me the names of the first 12 presidents of the United States, and it showed a picture of 9 presidents, and it also spelled half of their names wrong. And it's like, okay, awesome. Like, this is cool.
And it's not hard to misspell John Adams.
Yeah, it's tough. It's tough.
Tough one. That's awesome. Okay, so avoid the online research, the chat GPTs and all that. The CPA is going to know your situation a lot better and won't hallucinate, Baskins versus Robbins or whatever case.
Yeah. Well, I wouldn't say, I wouldn't say like don't research. It's always good to empower yourself with knowledge, but, don't implement anything, right, without actually going through your personal tax advisor. So you see, maybe you research something about ChatGPT, but always verify that with your CPA before you go out and form a new entity or just dissolve the entity and pull a property out. Because there are always going to be things that maybe you don't know of, or maybe some kind of wrong information or information that's not applicable to you specifically.
Gotcha. So I'm kind of imagining right now, if I'm a single property owner, I'm watching this to kind of learn more about the property I inherited or something that I'm managing right now. Maybe I have some ideas about next year and what I'm going to do. But my CPA is not real estate specific. So I'm imagining right now it's almost like those medicine commercials where they say, ask your doctor about.
Yeah.
What are some...
We're going to talk about Cialis now?
Yeah, that's right. But if you think, well, I don't know if my CPAs are as smart as Amanda and Matt, right? What would you say, or what should they be asking their accountants about to make sure that they don't accidentally make these mistakes, even with a CPA's help?
Well, I can tell you what they shouldn't ask, right? One thing they shouldn't ask is, do you work with real estate investors? Because every CPA is going to say yes, because they're going to have one person who does real estate, right?
Okay.
So you want to be more specific in your questions, right? Like tell me what your other successful real estate investors are doing. What markets they're investing in, that kind of thing, where it leads to a conversation and not just I work with real estate investors. Like,
Yeah, I think it's, if your CPA is not well versed in real estate, and real estate is one of the ways you build wealth, then it's important to make sure you seek advice of a CPA who is well versed in real estate. And that could look, that could show up in different ways. It could be, well, I'm no longer working with this CPA, just go to another CPA who is well versed in real estate and what I'm doing. Or it might be, I do like my current CPA, but they just can't help me with specific real estate topics, right? And so maybe you just work with a real estate CPA on the advisory side.
That makes a ton of sense. So it's almost, if you're watching this podcast and you're thinking about a real estate specific CPA for the first time, there's some good questions, Matt, that you provided. And if not questions, at least have a conversation so you can assess their background knowledge, right? Not just let them out with a yes or no. And then possibly go find the right CPA that's more real estate specific and is managing a client load that has portfolios, actual portfolios, making real cash flow. I'm going to go back to even one of the first things you said, which is interviewing CPAs. Because I imagine a lot of people just pick the first one with the highest star rating on Google. That's probably not very smart.
Yeah, or it's like my dad's used the CPA.
Or yeah, my neighbors used it, and I've known my neighbor for 20 years, and we are in totally different businesses. But yeah, who cares?
Yeah,
it's fine.
Yeah, a CPA is a CPA, which we're learning that is not the case. So I feel like we've prepared the audience to go out and find the right CPA. We've prepared the audience to understand the importance of financial records, to empower your CPA and yourself to actually have clarity on what you're doing. What would those two things give to the real estate investor, in terms of what do they start avoiding now? Like, what are some problems that they get to avoid if they do those things?
Yeah, some of the common mistakes we see, when we start working with new clients, one of the first things we do, our team is they'll review a most recent tax return year, right? And when we do a review, we're looking for opportunity areas that are lost and also exposures like, hey, this seems incorrect or seems like a made up number. And, probably roughly about 40% of tax returns we review are not optimized for tax savings. And some of the common ones I think Matt already mentioned is not capturing deductions, like the home office, travel, just things that are not super property specific, but are because you are a real estate investor, to make sure you're understanding what you can write off, but also have a good way of tracking it, right? Whether Excel, paper, software, that's key.
Yeah, and I think it also just points out opportunities, right? If somebody, if they've already been investing in real estate and they've treating it like, 99% of the people out there, we can walk them through like, here's something you can think about doing differently, right? Like if you want to, start self-managing your rental properties, your short-term rentals, maybe we can look at using the short-term rental loophole. If you've got a lot of long-term rentals and maybe one of the spouses is not working full-time, maybe a real estate professional is an opportunity for you. So it leads to conversations like that in terms of what can be done, what are you looking to do in terms of your portfolio and your growth and your goals and all that kind of good stuff.
Yeah. I was going to say depreciation, another common mistake area we see, right? For all real estate investors, depreciation is, pretty significant benefit. Now that the One Big Beautiful Bill has been signed into law.
Say that fast, right?
It more than doubled the potential tax savings of real estate in 2025. If you're someone who is purchasing rental property after January 19th, now you're potentially able to use 100% bonus depreciation rather than the 40% under previous law. So really important to make sure that you are taking advantage of it. You're optimizing your depreciation on the rental properties to offset the taxes on the rental income. And if you're, more strategic, then like, how do we offset other income we have from a business or from our W-2 job or from, retirement distributions?
But you brought up two things. The first is the One Big Beautiful Bill. But that one is interesting for the depreciation, and I think providing some education is really valuable there for investors. And the second, and one actually heard you guys talk about this on another podcast, the real estate professional qualification criteria, and how that can have a huge impact on taxes at the end of the year. That's also something I think I can imagine a lot of real estate investors learning about in a call like this and slapping themselves on the forehead because maybe they could have created the events that would have made them qualify 5-6 years. So I'd love for you guys to maybe expand first on what does it mean to be a real estate professional for tax purposes, and how can that impact your investment business?
Yeah, I think we'll start with kind of the benefit. Why do we care, right? So generally, when we invest in real estate, we have cash flow and appreciation, but on the tax return, we oftentimes show a loss. And the loss is from maximizing our deductions, capturing all the write-offs, and also the concept of depreciation, right? We can write off the purchase price of our building over time. And then the next question becomes, well, if I have a tax loss on my rentals, what kind of income can I offset? And for most people, if you're higher income, meaning if you make over $150,000, then these losses are considered passive losses, which means you don't lose them. We get to use them against other passive income, like other rental properties, or in the future when I sell a rental property. But a lot of investors prefer to get that immediate benefit today. So what if I created a loss, but I want to use it right now to offset taxes from W-2 income or a business that I have? And the way you accomplish that is if you or a spouse is a real estate professional. So in other words, being a real estate professional allows you to use rental real estate tax losses against all types of income rather than just passive income.
And getting to do so now, that's the huge benefit, right? You're getting the same benefits. It's just I'd rather get the deductions now versus spreading them out over 5 years, right? So if I can save taxes now, those tax savings can turn into a down payment on another rental property, right? So that's the beauty of being able to implement a strategy like that.
Mm-hmm. So naturally, then I think the question for a lot of people is, well, what is real estate professional? Because I would like to write off my income, right? So real estate professional is it's just something that exists in the tax world. So you don't have to be licensed as a realtor, start doing open houses. It's none of that stuff. Real estate professional is, there's basically 3 major roles you have to meet. So one is you have to spend at least 750 hours in real estate.
For the year.
For the year, yeah.
And so that could be you doing rentals as a landlord. That could be you flipping properties. That could be you being a property management company or managing your own rentals. And then the second role, which is the hardest one for most people to me, is you have to have more time in real estate than your job or businesses. So if, John is working full time at a W-2 job, that's 2,100 hours a year, you have to have more than 2,100 hours in real estate to be a real estate professional. And so that's the part that's harder for most people to meet. And then the third role you have to meet is material participation, which in a simplistic form is you're involved in the day-to-day operations of a rental property. Ideally, if you're self-managing, that's a really great fact pattern. You don't have to be self-managing, but if you are self-managing, that's really, really good, right? So this works out pretty well if you're someone who is not working full-time, works part-time, or you're married to a spouse who is maybe stay at home or not working full-time, because only one of you can have to qualify. Both of you could get the tax benefits of it.
Or if you're single and ready to mingle, go find somebody who does real estate all the time.
There you go. Then you'll get that makes a lot of sense. Is this, so this makes sense, especially, for folks who stay at home, right? The person staying at home doing a lot of the management activity. Does this also apply to, like, let's say, my spouse is a real estate agent? Would that apply in this context of that 750 hours?
Yeah, possibly. So if your spouse is a real estate agent, let's say she earns her commissions as a 1099, right? Then she's considered self-employed. So yes, then like she doesn't have to beat another job because her job then is real estate. She's in the real estate business.
Gotcha. Then
yes, it's much easier. So that's what we just taught for a group of realtors, and we're like, you guys, this is like a no-brainer, right? For realtors to invest in real estate, because you're 2/3 of the way there. You just have to own property.
Yeah.
So yeah, really, really great. A common profile we see is, one spouse maybe still working full-time, higher income, another spouse claiming the real estate professional status, and then using all the tax benefits to offset rental income as well as W-2 and other income.
Gotcha. And just to bring this home to like a situation that's easy to grasp that maybe comes out on some tax savings at the end. If I'm a 3 single family owner in town, right? I know there's a lot of details about the business that we'll leave ambiguous, but if I do this versus not do this, I mean, how much more income does this actually represent to me?
Yeah. Well, if we're talking specifically about tax savings, right, a very high level example, let's say I buy property for $130,000 and $100,000 is the building, right, that I purchased. Okay. In first year depreciation, if we're using 100%, your first year write-off might be $30,000 or even higher.
Oh, wow.
And that's, regardless of how much down payment, right, because the depreciation is just based on the purchase price.
So yeah, you could assume your property breaks even from a cash flow perspective, but with a $30,000 depreciation, now we've got a $30,000 loss that if you or your spouse qualified as a real estate professional, now we can deduct that against our W-2 and save the taxes at, whatever marginal rate that person's at. I mean, if it's federal and state's 40%, I mean, that's $12,000 in savings right there from that one property.
Wow. That's awesome. Okay, I think that really drives home the importance of being able to recognize this and can make mistakes that you might be doing for 5 years really really costly, right?
Yeah, it's tough because we do see this mistake somewhat frequently. So, the good thing about it is if, certain things in the tax world you can go back and do amended returns for, or you can catch it up.
Yeah.
If I didn't optimize my depreciation for all these years, and this is the first time I'm hearing about this bonus depreciation and accelerated depreciation, you can actually just catch up for a lot of those mistakes going forward, right? By filing certain forms and things like that. But I do think from, working with clients, one of the hurdles that people think in their mind is, gosh, how do I earn those hours? I have a stay-at-home spouse, and how do I convince them to do real estate? How can I manage my rental properties if they're not down the street from me? And so having platforms like TurboTenant is super amazing because it helps people to be able to self-manage if they choose to do that, right? It makes it easier. It's not like I'm a lone, whatever you call it, a lone cowboy out there trying to figure all these things out,
Is that what it's called?
I like that dance you did.
I feel like touching on this topic, and I know most of our audience is long-term, but I feel like we have to touch on the short-term loophole, considering we're talking about this right now. So could you, what is that and why is that cool?
Yeah, so we've had a lot of clients, obviously, over the last 5 years, a lot of people have invested in short-term rentals. I think from a tax perspective, the reason why, or the kind of low-hanging fruit, is that the strategy is very similar in the sense that, hey, we want to be able to use our short-term rental losses. We want to maximize our short-term rental losses through deductions, depreciation, and then use those short-term rental losses to offset W-2 and other income. And in the tax world, for whatever reason, short-term rentals are in kind of a different category than long-term rentals. And so the threshold to be able to do that, to be able to deduct those losses, is actually a lot lower than it is for real estate professionals or people investing in long-term rentals. And so the short-term rentals, it's more of are you basically active in your business? So they look at it like, can you meet material participation for your short-term rentals? So that could be, did you spend 500 hours a year on your short-term rentals? And this can be 500 hours on one property. It can be 500 hours spread out across multiple short-term rentals. So it doesn't have to be 500 on every property. If you can do that, great. Then we can use our short-term rental losses deduct against W-2, similar to what we were just talking about.
I see.
Now, if somebody can't get the 500 hours, it could be as little as you spend 100 hours working on your short-term rentals, as long as that's more than anybody else who spent time on your short-term rentals. Then in the IRS's eyes, that's an active business, and they allow you to deduct that loss. So it's a cool thing to have in your tool belt if short-term rentals make sense in your area or wherever you're looking to invest.
Yeah.
Because again, the bar and that threshold's a lot lower. So we've got a lot of clients who are spouses are both working full-time, and they're doing short-term rentals as a side hustle because they don't have to get 750 hours. They don't have to get more time in real estate than their other jobs,
That's awesome. I appreciate you sharing that because, in Colorado, it's a lot harder to get into the short-term rental game, but I've always been watching, and it's super interesting. Are there any other common mistakes we should give some airtime to beyond the two that we just talked about?
Gosh. Legal entity. Legal entity is sort of another hot topic. I think the common mistakes are people tend to assume you have to have a legal entity in order to take tax write-offs. We meet investors all the time who say, I would like to write off my car, when I use it for rentals, but it's in my personal name. It's not in an LLC. And so the one important thing to understand is when it comes to rental real estate, the entities typically are for asset protection purposes, not really for tax purposes. So if I'm a landlord, I can write off almost all the same exact things, regardless of whether I have a legal entity or if I own my rentals in my personal name. So to the extent you have an expense that's related to your business, and by business, we don't mean entity, we mean rental real estate business, right? You are able to write it off. So just making sure that you understand, what the implications are. For entity structure, I know oftentimes attorneys create entities that are more complicated, and that's totally fine, but we just always want to be cautious of the cost benefit. If I have multiple entities, multiple layers, what is it going to cost me every year to maintain it, to file tax returns, have bookkeeping for it?
Yeah.
And what is that additional asset protection benefit? Or is it maybe overkill, more than I need, right? Because I'm not a person who likes complexity. So being kind of careful and having that conversation with your tax advisor as well before going out and forming or dissolving entities.
Gotcha. I think that's a really interesting point too about the cost versus the risk mitigation that you've just set up for. Because I'm sure that doing the quick, I could lose the whole property or $500 a year, that makes sense. But you're also introducing this whole layer of headache, right? And just an organizational headache to deal with. And you don't necessarily want to saddle yourself with that. So we talked about entities. We talked a little bit about bonus depreciation. We didn't actually talk about how it changed this year. What's your guys' Sparks notes on it?
Yeah, so with the one big beautiful bill that passed recently, nice thing about that is that they did bring back 100% bonus depreciation. So it was set to kind of, we've had it for a few years, but it's been 100%, 80%. It was been, kind of phasing out. So the beauty of it is that it kicks in for any properties that were purchased and placed in service after January 19th this year. So I think if you look back, that might be the inauguration day. I think that was kind of the cutoff for some reason. But any properties bought and placed in service, rental properties bought and placed in service after January 19th for qualifying assets in that property. So typically 5-year property like personal property, furniture, appliances, equipment, 7 and 15-year assets. Like a 15-year asset in a rental property is like landscaping, shrubbery, fences, pools. Those kind of assets can qualify for 100% bonus depreciation. So if you put in those kind of assets in your business, instead of depreciating them for 5 or 15 years, you can now expense 100% of it in the first year. Or we haven't talked about cost segregation studies, but it's kind of supercharging depreciation, right? You can have somebody go in and look at a property that you bought that has some of that stuff in it. They go and do a study and say, hey, instead of depreciating this over 27 and a half years with the building, these are 5-year assets. You get to depreciate over 5 years. Well, then when you tack bonus depreciation on top of it, now we've been able to allocate, like Amanda was getting that example of a $30,000 over a $100,000 building.
Yeah.
That's an example of doing cost seg with bonus depreciation. So that's the power of it.
So it basically makes the deal math work without any of the crazy questions of time, right? For a
like
lot
as
of
Amanda mentioned, it's almost people doing cost seg studies and getting the bonus. It's more than doubling your benefit that you were going to get prior to the passage of the bill. So we've had people that, they went out in April, got a cost seg proposal. It's like, well, okay, we'll go back and revisit that proposal because they're guaranteed they're going to double your benefit when you relook at it again,
Yeah. I think what a lot of people don't know about depreciation in general is that it's based on the purchase price of a property, irrespective of what the down payment is. So if I'm buying a $500,000 property, that's my starting point for looking at depreciation and the whole calculation. And this is true regardless of whether it was an all cash purchase, right? 500,000 cash, or if it was no money down. I got 100% seller financing, I no money down, I still get that same depreciation. And that's very phenomenal when you think about how the tax law is designed to allow you to, get tax write-offs while using leverage, right? Because I'm basically depreciating money I haven't yet spent in cash, the bank's money, and taking depreciation on it. So pretty amazing.
Yeah, it's very amazing. So one thing we certainly love at TurboTenant on this podcast is talking about when it went wrong, and maybe when it went really wrong for landlords or real estate investors. Do you guys have a story that comes to mind for an investor that missed out on a huge opportunity because of an accounting mistake or lost a lot of money because of an accounting mistake that you could share?
Yeah, we talked earlier about the importance of working with a CPA who understands real estate taxes and tax planning. So we were once interviewed on a podcast, just like this forum, and we shared the tax strategies, and the host had told us like, oh, this is great. My CPA is real estate specific. He owns rental real estate. So, perfect. And maybe 5-6 months later, the podcast host reached out and said, Amanda, I need to change my tax return. I think I need to change my CPA. I said, what happened? He said, well, I was asking my CPA about cost segregation, right? How we can accelerate our depreciation and all that stuff. And his response is, what is that? And so, needless to say, we looked at the tax returns, never claimed real estate professional, even though clearly this guy does so much real estate that he has a podcast for real estate. And so I think the moral of the story is don't assume, right? Because for this guy, he's like, how could my CPA not know I'm a real estate professional? I have a show all about it. So don't assume your CPA is claiming these benefits for you. Don't assume you're doing accelerated depreciation. Ask. And don't just ask, hey, am I doing this? Am I doing that? Ask better questions. How much did cost segregation save me in taxes last year? Because that's a very pointed question. They have to give you an actual number, right? Much harder to do than to say, oh, yeah, of course we did it. We claimed this. We got it, right? So trust but verify.
Awesome. Cool. Thank you. And just for my own curiosity, do you know how long that person had their CPA? Like, how long had they been thinking this CPA was doing it?
I don't know, but it was many years. And it was interesting because so how did this happen? He's very confused because his CPA actually owns real estate.
Yeah.
And he's like, I thought for sure he owns real estate, it was commercial real estate. But again, if, it's one thing to be someone doing something, it's another to be an expert in that specific field, because that's a different hat, right? You could be a real estate investor and do taxes, but doesn't necessarily mean you're an expert at real estate tax. Of course, we assume you are because that kind of makes sense. But.
Right. Oh, my goodness. Well, man and Matt, thank you guys. I appreciate you guys calling out all these common tax mistakes that investors make, especially the small ones who are a little less sophisticated. I think it's really valuable for them. Where can they find more information about you guys?
Yeah, I mean, the best place to find us is our website, which is KeystoneCPA.com. We have a lot of great information, free resources on there, so you can get lost in all the fun tax stuff if you want to.
Yes, if you're looking for just tiny bite-sized tax tips during the week, I am mostly found on Instagram as Amanda Han CPA.
Awesome. And we'll put a link to your guys' website down in the description. And I also have a link too of a downloadable that if all they got to do is give you guys their email, and they'll get a lot of information for tax strategy. And the last thing I'll plug on your behalf is there's a book on Amazon.
Yes.
So go take a look. They've got a lot of information out there. Man and Matt are definitely thought leaders in the space for real estate investing for tax savings. So take a look. We're really glad you guys came on, if you can't tell.
Yeah, no, thanks for having us. This is super fun.
Awesome. Cool. Well, until next time, everybody, thanks for coming to Landlord Lens. Like and subscribe.